Let's continue the discussion from the last issue. Through the analysis of the previous issues, if you think you should hold silver, then how should we hold silver? Based on the lessons of the Hunt brothers and the analysis of the current market, a core question is placed before all investors: how should silver be held? The answer to this question is even more important than whether silver should be held, because it is directly related to the ultimate success or failure of the investment. There are two main ways to invest in silver, which represent two completely different philosophies. Physical silver, gold and silver coins, silver bars. This is the most direct and purest way to own. You hold a real, tangible asset that does not rely on the commitment of any financial intermediary and has no counterparty risk. In extreme crises, it is the ultimate means of storing value. The disadvantage is that the cost of storage and insurance needs to be considered, and there is usually a premium above the spot price when purchasing, and it will be slightly lower than the market price when selling. Paper silver, ETF, certificates, etc. This method provides great convenience, liquidity and low transaction costs. But its essence is a financial contract, a paper certificate. Your investment relies on a complex financial chain, including custodians, sub-custodians, authorized participants, etc., being able to fulfill its obligations. This means you bear counterparty risk. In the world of paper silver, there is an even more critical distinction between allocated and unallocated. Allocated, this means that there is a specific, serially marked silver bar or coin that is segregated and stored in your name. It is your undisputed property and cannot be loaned, leased by the custodian or claimed by its creditors in the event of the institution's bankruptcy. Unallocated, this means that all you have is a claim on the total silver inventory held by an institution. The institution has the right to use this portion of silver for leasing, lending or other financial activities. This practice is called rehypothecation. Under this structure, you are actually an unsecured creditor of the institution. In a financial crisis, if the institution has problems, the silver you own may not exist at all. This is the core risk of many paper silver products. For most investors who invest in silver through securities accounts, the most common choice is exchange-traded funds, ETFs. Among them, the two most representative ETFs are iShares Silver Trust, SLV, and Sprott Physical Silver Trust, PSLV. They are worlds apart in structure, which just reflects the core difference between non-allocation and allocation. Let's take a look at iShares Silver Trust, SLV. As the world's largest and most liquid silver ETF, SLV is a trust fund designed to track the spot price of silver. SLV has long been controversial. Its custodian is J.P. Morgan Chase, a huge financial institution, which itself brings counterparty risk. More importantly, the outside world generally doubts that the silver it holds may be non-allocation. Its opaque operation and possible leasing and rehypothecation behavior make it regarded by many as a paper silver tool. The most critical point is that ordinary retail investors cannot redeem their SLV shares for physical silver. Let's take a look at Sprott Physical Silver Trust, PSLV. PSLV is a closed-end trust fund designed to address the structural flaws of traditional ETFs such as SLV. Its core advantage is full allocation. PSLV's prospectus clearly promises that every ounce of silver it holds is a fully allocated, unencumbered London Good Delivery, LGD, silver bar. This is the most fundamental difference between PSLV and SLV. Investors who hold enough shares have the right to redeem their shares for physical silver bars and request delivery. This mechanism establishes a solid bridge between the paper market and the physical market, forming a strong arbitrage constraint and ensuring that its price is closely linked to the physical value. PSLV's silver is kept by the Royal Canadian Mint, a state-owned enterprise of the Canadian government, thereby minimizing the counterparty risk brought about by the bankruptcy of private financial institutions. For some U.S. investors, gains from holding PSLV for more than 1 year may be subject to lower long-term capital gains tax rates, 15% or 20%, rather than the collectibles tax rate, 28%, that applies to most precious metal ETFs and physical gold and silver. Why is the SLV versus PSLV debate central to the entire silver investment argument? Far from being a quibble over technical details, this debate over ETF structure choice gets to the root of the entire silver bull argument. The logic chain is as follows. The core logic of the bullish silver is based on physical shortages. Instruments like PSLV, due to their non-allocation potential, can create the illusion of ample silver supply by injecting paper supply into the market through financial operations such as leasing and remortgaging. This is equivalent to using paper water to put out a physical fire, which objectively plays a role in suppressing prices. Instruments like PSLV directly exacerbate physical market shortages by buying physical silver bars from the market and locking them in a fully allocated, redeemable form. Therefore, the flow of funds between PSLV and PSLV is itself an important market sentiment indicator. When funds flow from PSLV to PSLV, it is a sign that investors are losing confidence in paper promises and turning to physical reality. For an investor who firmly believes in the physical run theory, PSLV is a choice that is more in line with their investment logic in terms of ideology and structure. The choice between PSLV and PSLV is not just a preference, but also a vote on the direction of future market evolution. Do you believe that the coming will be a paper carnival or a physical world liquidation? The above information makes a simple and clear explanation of the complex and often confusing differences between the two mainstream silver ETFs, which can help investors make wise decisions based on their own risk preferences and investment philosophy. Combining all the above analysis, we see a clear picture emerging. Silver is at the center of a perfect storm. Three powerful and mutually reinforcing forces are converging, heralding the beginning of a potential supercycle. First, the historic valuation trough. The gold-silver ratio is still at a historical high, which means that compared with gold, silver has huge room for upward repair. Historical experience shows that in a bull market, this repair is often completed with an explosive rise in silver prices. Then there is the structural industrial deficit. Unprecedented, price-inelastic industrial demand from the green energy and high-tech sectors is continuously and irreversibly consuming the physical supply of global silver. This is a solid fundamental that no previous silver bull market has had. There is also a decisive monetary catalyst, with global central banks about to start a new round of easing cycles and the continued erosion of fiat currency credit. It is only a matter of time before a new wave of investment demand arrives. And this wave will hit a market that has been depleted of inventory by industrial demand. Based on the above analysis, a silver bull market that lasts for many years is not only possible, but also a high probability event. Here I make a prediction of the future price of silver. Medium-term goal, 1 to 2 years. With the initial awakening of investment demand and the partial return of the gold-silver ratio, it is a more conservative initial goal for silver prices to return to and challenge the historical highs of about $50 per ounce set in 1980 and 2011. Long-term goal, 3 to 5 years. As physical shortages deepen and the effects of currency debasement fully emerge, silver prices are expected to far exceed previous historical highs. Some even predict that it will reach $120 by 2028. Considering the resonance effect of various factors at present, a price range of $100 to $130 per ounce is a well-founded and reasonable long-term forecast. If a more serious financial or geopolitical crisis breaks out in the next few years, causing physical silver to become scarce, then the price may even rise beyond imagination. All evidence strongly points to one conclusion: silver is standing at the starting point of a major, long-term bull market. For investors who firmly believe in the physical is king and physical run theory, the most direct and safest way to participate in this feast is to hold physical gold and silver coins or bars, or invest in fully allocated, redeemable trust funds like PSLV. For investors with higher risk tolerance and seeking leverage, high-quality silver mining company stocks, which can be held through ETFs such as SIL and SILJ, provide a high-return option. History shows that in a precious metals bull market, miners' stocks tend to outperform the metals themselves many times, as demonstrated in 2000 to 2008. The current market environment provides investors with a once-in-a-lifetime strategic opportunity to allocate a portion of their assets to this unique asset that has both a long monetary history and an indispensable role in the future's cutting-edge industries. Now is the time to act before the storm hits in full force. The above is a little information and personal opinion shared with you today. It is not an investment advice, so please do not blindly follow it. Thank you for your company.